Because day trading has we've in modern days loosened the definition. But day trading, when I started trading, you had to declare yourself a day trader to your broker. And he put certain rigid requirements on your capital and how your account was handled. And you had to be a day trader. Under no circumstances could you keep an account or keep a trade open overnight. They'd automatically be closed for you. Today with CFD trading, we have the luxury of letting our trades roll over day after day after day after day. We can close them, but as long as we can cover the margin, we can keep those positions open for a long time. So to be honest with you, most people today are positional traders. They want to call themselves maybe swing traders, but swing traders are actually take a little bit longer time frame. So we have all types of traders. We have trend trading, scalp trading, position trading, range trading, day trading, swing trading. And if you look here in this little Venn diagram, you can actually see where everything kind of falls apart, because most traders are range trading or they're trend trading. Position trading is this little, I don't know what color this is, reddish ball in the center. But that's by the true definition. But if we were to take in all of these trend traders and range traders, we would find out, if we truly looked at their accounts, that they would be all incorporated in what is position trading or positional trading. Now, Forex trading requires putting together multiple factors to formulate a trading strategy that works for you. A trading strategy that works for you is important. There are countless strategies that can be followed. However, understanding and being comfortable with the strategy is essential. Every trader, every one of you out there, has a unique goal and unique resources. Resources are what? Your experience, your finances, your knowledge, your emotional security, okay? The time element, which all have to be taken into consideration when considering a suitable strategy. So there are three criteria traders can use to compare different strategies on their suitability: time resources, frequency of trading opportunities, and typical distance to target. How long are you willing to wait for that trade to become a trade? And then how long are you willing to wait till it reaches the target price in which you've made your profit? Most of us want that all to happen in a few hours or a day. Now, to easily compare the Forex strategies on three criteria, we've laid them out in the bubble chart. Okay. And one of the things we've considered is risk-reward ratio. Position trading typically is the strategy with the highest risk-reward ratio. On the horizontal axis is time investment that represents how much time is required to actively monitor your trades. The strategy demands the most terms of your time resources is scalp trading, due to the high frequency of trades being placed on a regular basis. So here we can see those same colors. Now these bubbles represent the time element, the risk reward ratios. So all the way up here, we have position trading. It offers two things. It offers the best time investment and the highest risk reward ratio, because they are slower trades. They take you more time to get into position and then more time to reach your target. But they don't require minute by minute monitoring, because you're not dealing with a very highly erratic market. Dealing with the same assets, but you're looking at it in a different way. Positional trading is all about having your positions open for a long period of time, so you can catch some large market moves. The rule of thumb is to avoid using high leverage and keep a close eye on the currency swaps. Now, this is one of the problems we have. Most of you would like to get into trading with a $500 account or a $250 account and leverage all the way up using 10 to 1, 20 to 1, 30 to 1, and you've leveraged up 30 to 1 on a $500 account, so you have a $1,500 trade going on. And in order to cover yourself, you've got to put your stop loss very, very, very close. Now, even though we saw the euro climb up to 120. Now, we knew it wasn't going to sustain 120 and it was going to come down, but we didn't know how long it would take to get there. Now, we could have entered that euro here one night. In fact, in a class I was giving a couple of weeks ago, the euro was a 119.32 that night. Everything was saying a buy opportunity. I told everybody. And it doesn't mean I'm right or wrong or I'm a genius. I said I would never buy the euro that close to 120. I would look to sell it because if anything, it's going to slowly grow back down. But it doesn't mean it's not going to pop up here for a couple of bits for a day. If you were to be leveraged and you don't have the money to cover the margin call or the margin, and you've got to state your stop loss here, you're in trouble. But as we've seen, the euro's fallen over 200 points. You could have made a very nice trade. And not guesswork, it would have been a beautiful trade. With positional trading, you can learn not only Forex trading strategies, but also the skill you need to become successful. It's a good method for achieving high profits, but it can also put your emotions through a test. With positional trading, you must dedicate your time to analyzing the markets and predicting potential market moves. However, there's almost no time spent on the execution of your trading strategy. Position traders are, by definition, trend followers. Their core belief is that once a trend starts, it's likely to continue. Okay. Now, remember, we've talked about a trend, and we talked about the randomness of markets. And markets are generally random, but when a beautiful trend, a push, ease, push, ease, push, ease, push, ease, starts to develop, it takes momentum. And once these traders start rolling and rolling and rolling on that momentum, it's a hard thing to stop. It's like hamsters in a wheel, in their cage in a wheel. You're amazed that they can go on and go on for so long pushing that wheel. But it really is, the hard work is getting it started. Once it starts, the momentum and the speed carries it forward and makes it very easy to continue forward. And a trend, unless other fundamental device really happens, is very easy to find, very easy to enter and to ride out a trend. But that trend could take days or sometimes weeks to expire. It may not be moving that fast, so you have to be ready to sit it out. But you also have to be ready for push, ease, push, ease, push, ease, push, ease, push. ECB says something stupid. Ease, push, ease, push, ease, push, ease. You have to be able to cover that stop loss. Okay. That doesn't mean you've lost your money. You just can't have your stop loss placed so close that you have the possibility. Now, all of this was within your risk reward ratio calculations. But you have to remember, when you set your risk and reward, you have to have that high reward. You have to have that maximum potential reward so that you can, or see that maximum reward, so that you can put your risk where it needs to be, not where you feel comfortable placing it. So the trading philosophy is geared towards successfully capturing the bulk of a trend's move, which would result in appreciation of their investment capital. As such, it is the opposite of day trading, which seeks to take advantage of short-term market fluctuations. It also differs from swing trading in that both are based on concepts of trend following. Position traders hold their position for a much longer time frame than swing traders. Position traders use technical analysis, fundamental analysis, and a combination of both to make trading decisions. They also rely on macroeconomic factors, general market trends, and historical patterns to select investments which they believe will achieve their desired goal. Now, if you think of swing trading as you're one step below investing, because with investing, we're looking to buy and hold, put it away that it's going to go up steadily in value. So all those people that buy Apple in March and sell it in April, what are they? Well, most are positional traders. Most of them are just lucky guessers because they're not really trading. They're calling their broker and saying, buy me some Apple. They're not following Apple. Now, fundamental analysis is especially important for position traders who expect to hold the asset for a longer period of time. Fundamental analysis is position trading is frequently associated with stock picking. It allows traders to find winning stocks that may provide higher returns. Technical analysis is used to identify trends in asset prices that allow a trader to earn profit. In addition, it aims to identify trends that will last long enough and provide warning signals of potential trend reversals. Technical analysts usually provide position traders with two options: trade the asset with strong trending potential that have not yet started trending, or trade the asset that have already begun trending. In other words, we talked about the euro when it was up at 120. Okay. Now, there was no trend indicating it was going to reverse, but it had hit a rock hard place, and it was a really high price for where it was going, and you had a choice. So in the first option, may provide higher returns. That's entering without a trend, trying to enter before the trend. But see, the nicest thing about position trading is you can well wait for that trend to establish itself. Now, but it is riskier and more research intensive. On one hand, the second option is less research intensive, but the trader may miss the momentum to earn substantial profits. Technical analysis is the most effective tool for analyzing market conditions. Position traders have developed a combination of indicators to monitor the market's activity and identify strong trends before they start. Furthermore, position indicators can also signal the end of a trading cycle. Now, traders can try to modify the periods of exponential moving averages and stochastic RSI oscillators. The only difference is in the frequency of trading cycles. The nature of technical indicators in the difference of periods. When it comes to moving averages, the key comes together with a crossover or using a moving average crossover strategy. To help you understand the finer points of this trading style, let's take a closer look at a hypothetical trade. Imagine in March 2020, you believe that Amazon is set to benefit from a boom in e-commerce spending. If only we had imagined. We had imagined that Corona could have sent Amazon through the roof. We would have all only bought Amazon. So if you're right, then the price of Amazon could rise over the next few months. So you could decide to purchase some shares. On March 18th, you purchased 10 shares at $1,800 each. And you want to make sure to exit the stock if you are losing money. So you place a stop loss order at $1,600 below the recent price swing low. Okay. So that's a big price gap. You have to be able to afford it. So if you either bought the shares or you're not leveraged, or you're leveraged, using small leverage, feeling happy with your position, you check on the stock price every couple of days. Isn't that nice? You only have to check on the price every couple of days and watch as it zigzags its way up around $2,400 by late April. Now, I bought at 18, it's at 24, 10 shares, that's $600 a share. That's $6,000 I made. you're happy with the gain and sell all of your Amazon stock, making, oh, you bought 10 shares at a total of $1,800. Okay. And you sold them at 24. Oh, no. You bought them. Yeah, that's still a bad calculation. You bought them at 18, sold them at 24. That's still $600 a share of profit. Some, yeah, my math is right. 1824 is. Okay. Now, many traders discuss trading styles by relating them to a chart time frame. For example, they'll say that day traders look at 5-minute charts, swing traders look at 1-hour charts, position traders look at daily charts, and investors look at weekly charts. I think this logic is a bit simple and closed-minded. It's smart to look at multiple chart time frames for information that you need. Imagine if you want to be in and out of a trade within a month. You might start looking at the overall trend on the weekly chart, marking long-term support and resistance. Then you might look at the daily chart to get closer to the action and determine key levels over the past 2 weeks. Then you could look at the 1-hour chart to find an entry pattern. Using all 3 time frames, you can find an entry point, trading off a long-term support and hopefully making a great trade. But on the other hand, you can make longer term trades of around 6 months in duration. So you can be a short-term position trader or a long-term position trader. You may start by taking a long-term view of a stock's monthly chart, examining price trends going back for 10 years or more, seeing if a stock is in a long-term uptrend. You switch to a weekly chart, and there you see a recent pullback pattern. You mark in some key support and resistance zones. Next, you look at the daily chart for a chart entry. You see a simple breakout pattern, which offers you a smart place to enter, as well as a smart place to put your stop loss. By acting as a detective and looking at the stock price step by step, you found yourself a position trading setup with great potential. So what strategies do we want to apply? So we're going to take a look at the Canadian dollar, Japanese yen. Now, Canada is one of the world's largest oil producing nations. It's well-known exporter of this commodity. So the Canadian dollar normally rises when oil prices go up. In contrast, Japan is considered to be a net oil importer. This causes the yen to weaken when oil prices gain. This situation makes oil prices dramatic, a leading indicator for the movement of the Canadian dollar, Japanese yen. So where would we start? We would start with the daily time frame, and then our long-term trade setup would be first identify the resistance on the chart and the support on the daily chart of the oil futures. We want to find candlesticks that close above the resistance level. And then we want to open a long position on the Canadian dollar, Japanese yen as soon as the next candlestick opens. We want to place the stop loss at the significant support loss entry level and so to take profit below the next significant resistance level against the entry. So here we've set our stop losses. We opened a long position when the oil report and the oil pricing started to change. We see the Canadian dollar, Japanese yen start to sail up. We took our profit here, which was our basis on our risk reward ratio. And this was at our resistance level. And we got a nice little trade in. So what do we want to do is we want to identify, find, open, place, and set. So we want to identify the key support of oil charts on the daily time frame. Find a candle that crosses that support. Open a position, the Canadian dollar, Japanese yen at the opening of the next candlestick. Place a stop loss at a significant resistance level before entry and set a take profit below the next significant stop loss. Here we see in the opposite direction. To be a successful position trader, you'll need to use a mix of fundamental analysis and technical analysis. And that was just really an example of how fundamental analysis affects a technical trade, because the oil reports and the oil pricing is fundamental analysis. To be a successful position trader, you'll need to use a mix of fundamental analysis and technical analysis to evaluate potential trend and risk before opening a trade or investing. Support and resistance levels can help you recognize whether an asset's price is more likely to fall into a downtrend or increase into an uptrend. Based on this assessment, you can decide whether to open a long position and profit from weekly, monthly, or yearly increases in price, or a short-term position to profit from prolonged drop in prices. A support level is the price an asset will not usually fall below, as buyers tend to purchase the asset at this level. The resistance level is the point at which the price of an asset ceases to rise, because buyers will tend to stop purchasing the asset at that level. If an asset breaks through resistance, it could indicate that the price will go on to the next higher highs. And if it breaks below support, it could indicate that the price will go on to the next lower lows. So here's a simple support and resistance strategy that can be used for longer term or medium term position trading. Support and resistance levels are essential tools to analyze long-term trends, which will come in use if you're looking to start position trading. There are three main factors to consider when trying to identify support and resistance levels. Number one, the historical price is the most reliable source for identifying support and resistance levels. Normally, periods of significant gains or reductions in price will be used as potential indicators of future price movement. Similarly, position traders can look at previous levels of support and resistance as an indicator of future movements. For example, if a support level is breached, it could turn into a resistance level in the future trades. Finally, certain technical indicators can provide dynamics, support, and resistance levels which change with the price of the given asset. You can also use Fibonacci retracement. A Fibonacci retracement is a technical indicator that can help you to decide when to open and close a trade when using a position trading strategy. So Fibonacci levels give you support and resistance levels or retracement points that we can use for either opening a trade or for exiting a trade when we're using our position trading. To calculate Fibonacci retracements, position traders draw 6 lines across on the asset's price chart. The first line goes at 0, then at 50. Now 50 isn't a Fibonacci level. 50 comes from Dow theory, but it's been so popular it's been incorporated into the Fibonacci retracement tool. And then one line at 0. This is position traders will draw 3 additional lines: 61.8, 38.2, and 23.6. In theory, these percentages adhere to the golden ratio, which can sometimes be used to identify support and resistance levels. It is at one of these points that position traders may choose to open or close a trade. Position trading sounds simple, but it involves carrying out detailed fundamental and technical analysis, as well as a thorough understanding of the markets. So here are some key points to keep in mind. Support and resistance levels can help you recognize when an asset's price movement is more likely to fall into a downtrend or increase into an uptrend. Breakout trading is a good strategy to use in the early stages of a trend, but you'll have to be comfortable identifying periods of market support and resistance to spot an opportunity. Range trading is best used in markets which move up and down with no obvious trends, including some Forex markets. A pullback trading strategy can enable position traders to buy low and sell high, so long as the asset's upward price momentum recovers after a temporary dip, instead of progressing to a more permanent bearish reversal. So there you have a set of rules and some things to think about. Not all of us have to be quote unquote day traders. Not all of us have to make trades that fast that we want to, go through lots of money. Leverage can be an enticing thought, but using lower leverage to allow you to set farther risk reward ratios that allows you to keep a trade open longer during blips in the market can be turn you into a successful trader, but a different type of trader. So thank you very much for joining us today. I hope you learned a little bit about position trading, and we'll talk to you again real soon. If you do have any questions, go to www.legacyfx and click on the live chat button. Go over to their education center, or send them an email through contact us. They'll be glad to talk to you one-on-one and answer all of your questions and help you get started or just answer your questions.